Anticipated 50% market growth in banking, supply chain, real estate, and insurance by Q4 2025. Overview. In late January 2025, a comprehensive report highlighted the expected 50% growth across four critical sectors: banking, supply chain, real estate, and insurance by Q4 2025. This anticipated growth is shaped by macroeconomic factors, shifting competitive dynamics, and evolving regulatory landscapes, particularly in Asia and Europe. The report synthesized insights from industry leaders and analysts, including Deloitte, to project the market's trajectory amid global uncertainties. Banking sector outlook. Current challenges. The banking sector is navigating a challenging landscape characterized by macroeconomic uncertainties, geopolitical tensions, and regulatory shifts. According to Deloitte's analysis, economic growth, U.S. GDP growth, is projected to slow to approximately 1.5% in 2025, prompting the Federal Reserve and other central banks to lower interest rates to stimulate economic activity. Net interest income, with high deposit costs and anticipated interest rate cuts, banks are expected to see a decline in net interest income. Increased demand for mortgages may offset some losses. However, rising delinquencies in credit card and auto loans could pose significant risks. Strategic adaptations. To thrive in this environment, banks must adopt proactive strategies. 1. Diversification of revenue streams. Banks are encouraged to enhance non-interest income through investment banking fees, asset management, and other revenue-generating activities. 2. Technological integration. Embracing AI and digital transformation is crucial for improving operational efficiency and customer engagement. 3. Cost management. Expense management will be vital as banks work to maintain profitability amid rising operational costs. Regulatory changes. The Basel III Endgame proposals aim to lower capital requirements for banks, potentially leading to an uptick in mergers and acquisitions among smaller institutions. Banks will need to navigate these evolving regulations while positioning themselves for growth. Real estate sector recovery. Market sentiment. The commercial real estate (CRE) sector is showing signs of optimism for recovery in 2025. Revenue growth expectations. A recent Deloitte survey indicated that 88% of executives expect revenue growth in 2025, a significant shift from previous years of decline. Interest rate cuts. Anticipated interest rate cuts and reduced inflation are contributing to positive sentiment among real estate executives. Focus on sustainability. Sustainable real estate investments are becoming increasingly important, with many firms planning deep energy retrofits to enhance property value and comply with regulatory demands. This shift aligns with global trends toward environmental responsibility. Refinancing risks. Despite optimism, challenges remain regarding refinancing maturing loans, particularly in the U.S., where $600 billion in loans will mature in 2024. The market must navigate these refinancing risks as interest rates remain elevated. Supply chain dynamics. Technology adoption. While not extensively detailed in the provided sources, the supply chain sector is expected to benefit from increased efficiency and technology adoption. Digital transformation. Companies are likely to invest in digital solutions to enhance operational resilience, learning from recent disruptions. Global supply chain adjustments. The ongoing geopolitical tensions may prompt companies to re-evaluate their supply chain strategies, focusing on resilience and flexibility. Insurance sector trends. Innovation and regulatory adaptation. The insurance industry is projected to grow as firms adapt to changing regulations and consumer demands. AI and data analytics. Innovations in AI and data analytics are set to improve underwriting processes and risk assessments, enabling more competitive product offerings. Regulatory compliance. Insurers must navigate evolving regulations across regions, particularly in response to climate-related risks and consumer protection laws. Common themes across sectors. 1. Economic uncertainty. All sectors are grappling with macroeconomic pressures that could impact growth. 2. Technological integration. Digital transformation is critical for enhancing efficiency and competitiveness across industries. 3. Regulatory adaptation. Evolving regulations are influencing strategic decisions, particularly in banking and real estate. Conclusion. The projected 50% growth across the banking supply chain, real estate, and insurance industries by late 2025 reflects a confluence of economic recovery, technological innovation, and regulatory adaptation. While challenges remain, particularly regarding refinancing risks and operational costs, firms that adopt proactive strategies and leverage technological advancements are well positioned to capitalize on the anticipated market growth. The landscape is dynamic, requiring ongoing vigilance and adaptability to navigate the complexities of the global economy. The anticipated 50% market growth across the banking supply chain, real estate, and insurance industries by Q4 2025 is influenced by several macroeconomic factors. Competitive dynamics and evolving regulations, particularly in Asia and Europe. Below are some counterintuitive insights derived from the content analyzed. 1. Banking sector growth amid economic slowdown. While the banking sector is expected to grow, it faces challenges due to macroeconomic uncertainties, including a projected slowdown in U.S. GDP growth to 1.5% in 2025. Traditionally, one might expect that a slowdown would hinder growth in banking. However, the anticipated decrease in interest rates is expected to stimulate demand for mortgages, which could lead to increased net interest income despite the pressures from high deposit costs. 2. Commercial real estate CRE recovery. CRE is expected to rebound significantly, with 88% of executives anticipating revenue growth in 2025. This is surprising considering the previous years of decline and the ongoing challenges related to refinancing maturing loans. The optimism surrounding interest rate cuts and a reduction in inflation may provide a boost. But the extent of growth amid such significant refinancing risks is counterintuitive. 3. Regulatory changes and their impact on growth. The Basel III Endgame proposals are expected to lower capital requirements for banks, which would typically be seen as a boon for growth. However, this could also encourage mergers and acquisitions (M&A) among smaller institutions. The expectation of increased M&A activity contrasts with the common perception that regulatory environments stifle competition and growth, demonstrating a nuanced interaction between regulation and market dynamics. 4. High consumer debt versus increased loan demand. The banking sector anticipates an increase in mortgage demand even as consumer debt reaches an all-time high of $17.7 trillion. Intuitively, one might assume that high consumer debt would suppress further borrowing. However, the demand for mortgages appears resilient, suggesting that consumers are willing to take on more debt under specific conditions, such as favorable interest rates. 5. Insurance sector innovations amidst regulatory pressures. Despite the evolving regulatory landscape, which often constrains operations, the insurance sector is poised for growth through innovation in AI and data analytics. This contrasts with the typical view that increased regulatory scrutiny slows innovation. Instead, firms are leveraging technology to enhance underwriting processes and risk assessments, potentially making them more competitive. 6. Sustainability in real estate versus financial viability. The push for sustainability in real estate, particularly through deep energy retrofits, is expected to coexist with financial viability. This is counterintuitive, as sustainability initiatives are often perceived as costly and burdensome. However, the growing recognition of sustainability as a long-term investment strategy suggests that firms can achieve both environmental goals and financial returns. 7. Technological investment amidst economic uncertainty. Despite economic headwinds, companies across sectors are increasing their budgets for technology investments. This is counter to the typical corporate behavior of tightening budgets during downturns. The belief that investing in technology will yield long-term operational efficiencies and competitive advantages indicates a fundamental shift in strategic corporate thinking. 8. Consumer expectations in banking services. In the retail banking space, while there is pressure to reduce fees on services like overdrafts, banks may turn to charge for services that were previously free. This could seem counterintuitive given the potential backlash from consumers. However, banks are focusing on service bundling and tiered accounts, suggesting an adaptive approach to changing consumer preferences rather than simply accepting reduced margins. 9. AI as a catalyst for change in real estate. The adoption of AI in the commercial real estate sector is still in its early stages, with many organizations only piloting or researching its applications. The counterintuitive aspect is the belief that even minimal AI implementation can lead to significant transformative impacts on efficiency and decision-making processes, despite the industry being traditionally slow to adapt to technological changes. 10. Regional economic differences and their impacts. The expectation that different regions will experience varying growth rates and regulatory impacts is noteworthy. For instance, while North America may experience slower growth, the Asia-Pacific region's banks are predicted to perform better due to high-growth emerging markets. This regional disparity contradicts the notion that global economic trends will uniformly affect all markets. These insights showcase how growth in these sectors may defy traditional expectations, highlighting a complex interplay of external pressures, regulatory changes, and innovative strategies that could drive market growth in unexpected ways. Key insights and overlooked details in the report on market growth across banking, supply chain, real estate, and insurance. The anticipated 50% growth across the banking, supply chain, real estate, and insurance industries by Q4 2025 is underpinned by several macroeconomic factors, regulatory changes, and technological advancements. While many of these elements are highlighted in the report, certain critical insights and nuances may be overlooked, yet they hold significant implications for industry stakeholders. 1. Macroeconomic factors and consumer behavior. The report mentions that while the U.S. GDP growth is projected to slow to around 1.5% in 2025, there is a nuanced implication of consumer behavior that could impact industries differently. With consumer debt reaching an all-time high, the anticipated decline in consumer spending could lead to reduced demand for loans, particularly in the credit card and auto loan sectors. This is significant because it suggests that while mortgage demand may rise due to lower interest rates, other segments of the banking industry may face challenges that could dampen growth. Stakeholders must consider how this bifurcation in consumer behavior can impact their strategic decisions. 2. Commercial real estate CRE sentiment shift. The report cites a significant turnaround in sentiment within the CRE sector, with 88% of executives expecting revenue growth in 2025 compared to previous years. However, the underlying uncertainties regarding refinancing maturing loans, particularly the $600 billion due in the U.S. in 2024, indicate a potential crisis that could arise if economic conditions do not stabilize. The growing focus on sustainable real estate investments is also a critical trend that could reshape market dynamics. Yet many firms are still grappling with how to implement these strategies effectively. The report suggests that the ability to navigate regulatory pressures related to sustainability could create both risks and opportunities for CRE stakeholders. 3. Supply chain dynamics and digital transformation. While the report briefly touches on supply chain dynamics, it lacks an in-depth exploration of how the pandemic has permanently altered consumer expectations and operational efficiencies across industries. Companies are likely to prioritize investments in technology not just for resilience but to meet rapidly evolving consumer expectations for speed and transparency. The implications of this shift are profound. Businesses that fail to adapt to these new operational realities may find themselves at a competitive disadvantage. 4. Insurance sector innovations. In the insurance industry, the anticipated growth driven by AI and data analytics is noteworthy. However, the report may understate the transformative potential of these technologies. Insurers that leverage AI effectively can significantly enhance underwriting processes and risk assessments, leading to better pricing models and customer insights. This capability will not only improve profitability but also enable insurers to offer more personalized products, a trend that could redefine competitive landscapes. Firms that invest in these technologies early stand to gain a substantial competitive edge. 5. Regulatory changes and competitive dynamics. The evolving regulatory landscape, particularly in Europe and Asia, is a critical factor that the report highlights but does not fully dissect. The Basel III endgame proposals, which aim to lower capital requirements, could lead to an uptick in mergers and acquisitions (M&A) among smaller banks. This regulatory shift is significant because it may reshape competitive dynamics within the banking sector, allowing smaller institutions to consolidate and create larger, more resilient entities. Such changes could also spur innovation as banks seek to optimize their operations in response to new capital structures. 6. Technological integration and AI adoption. The report emphasizes the push for digital transformation across all sectors but does not adequately address the challenges associated with integrating new technologies, particularly AI. While many organizations express enthusiasm for AI deployment, the reality is that firms often face significant barriers related to data quality, legacy systems, and change management. Addressing these challenges effectively will be crucial for realizing the full potential of AI and other technologies. Stakeholders must recognize that successful technology integration requires not only investment in new tools but also a strategic approach to organizational change. 7. Investment in sustainable practices. The shift towards sustainability is highlighted in the report, particularly in the real estate sector. However, the potential financial implications of failing to adopt sustainable practices are significant and may be underestimated. Companies that do not prioritize sustainability could face increased regulatory scrutiny, reputational damage, and financial penalties as consumer expectations shift toward responsible business practices. The report indicates a growing consensus on the need for deep energy retrofits, yet many firms may still be hesitant to invest in these initiatives due to perceived upfront costs. This presents an opportunity for companies that lead in sustainability efforts to differentiate themselves in the marketplace. 8. Global perspectives and regional variations. The report outlines expectations for growth in different regions, but it may overlook the complexities of global competitive dynamics. For instance, while Asian markets are expected to experience growth, the timing and nature of regulatory changes may create uneven playing fields. Companies operating in multiple jurisdictions must navigate these complexities to optimize their strategies effectively. Understanding regional variations in regulatory environments and market conditions will be crucial for firms aiming to capitalize on global growth opportunities. Conclusion. In summary, while the projected 50% growth in banking, supply chain, real estate, and insurance industries by Q4 2025 is promising, several nuanced factors warrant deeper consideration. Stakeholders should closely monitor consumer behavior shifts, regulatory changes, technological integration challenges, and the imperative of sustainability. By doing so, they can position their organizations to not only navigate the anticipated growth but also mitigate potential risks and seize emerging opportunities. 1. Macroeconomic and regulatory influences on banking. The banking sector is expected to face a challenging environment driven by macroeconomic uncertainties, geopolitical tensions, and evolving regulations, particularly in the US and Europe. While US GDP growth is projected to slow, central banks are likely to implement interest rate cuts to stimulate economic activity. This may lead to decreased net interest income for banks, particularly due to high deposit costs. The anticipated regulatory changes, such as the Basel III endgame proposals, may lower capital requirements, potentially fostering mergers and acquisitions among smaller institutions. Understanding these dynamics is crucial for banking executives as they strategize for sustainable growth amidst a complex landscape. 2. Commercial real estate recovery and sustainability focus. the commercial real estate (CRE) sector shows signs of optimism, with a significant percentage of executives expecting revenue growth in 2025 driven by anticipated interest rate cuts and a focus on sustainable investments. The sector is also grappling with refinancing risks as many loans mature, particularly in the U.S., where significant volumes are due. The shift towards sustainable real estate and energy retrofits is becoming imperative not just for regulatory compliance but also for enhancing property value and meeting evolving market demands. The interplay between recovery prospects and sustainability initiatives will be a key topic of discussion moving forward. 3. Insurance sector's adaptation to innovation and regulations. The insurance industry is poised for growth by incorporating innovations like AI and data analytics, which can enhance underwriting processes and risk assessments. As regulations evolve, particularly in Europe and Asia, companies must adapt to meet changing consumer demands while remaining competitive. The ability to leverage technology effectively will be essential for insurers to offer innovative products and manage risks efficiently. The ongoing transformation within the industry presents both challenges and opportunities for growth, making it a critical area for analysis. 4. A technological integration across industries, across banking, supply chain, real estate, and insurance. There is a notable push towards digital transformation. Companies are increasingly recognizing the need to integrate technology, particularly AI and data analytics, to enhance operational resilience and efficiency. This trend is driven by lessons learned from recent disruptions, and organizations must prioritize their investments in technology to remain competitive. The successful implementation of these technologies will hinge on overcoming challenges related to legacy systems and ensuring data quality and security. The integration of technology forms a common thread across all four sectors and serves as a pivotal point for strategic discussions. 1. The Great Depression, 1929 to 1939. The Great Depression was a severe worldwide economic downturn that began in the United States following the stock market crash of October 1929. It led to massive unemployment, a significant decline in consumer spending, and widespread poverty. The banking sector was particularly hard hit, with thousands of banks failing as depositors lost faith in the financial system. The event prompted drastic changes in banking regulations, including the establishment of the Federal Deposit Insurance Corporation (FDIC) in 1933 to protect depositors' savings and restore trust in the banking system. The regulatory landscape evolved significantly during this period, resulting in reforms aimed at preventing such a crisis from happening again. 2. The 2008 financial crisis. The 2008 financial crisis was a major worldwide economic crisis that occurred due to the collapse of the housing bubble in the United States, leading to a severe recession. The crisis was exacerbated by the proliferation of complex financial products, lax lending standards, and inadequate regulatory oversight. Major financial institutions faced insolvency, prompting government interventions including bailouts and the implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This act aimed to reduce risks in the financial system by increasing regulation, enhancing the oversight of financial institutions, and introducing measures to protect consumers. The aftermath of the crisis led to significant changes in banking and financial regulations globally, influencing the competitive dynamics of the industry. 3. The Asian financial crisis, 1997 to 1998. The Asian financial crisis began in Thailand in July 1997 and quickly spread to other East Asian economies, leading to severe economic turmoil. The crisis was triggered by the collapse of the Thai baht, which was linked to the US dollar. Many countries faced significant capital outflows, leading to currency devaluations and economic downturns. The crisis prompted international financial institutions, including the International Monetary Fund (IMF), to intervene with bailout packages and impose strict austerity measures on affected countries. The aftermath resulted in reforms aimed at stabilizing financial systems, enhancing regulatory frameworks, and improving transparency in the banking sector. This crisis highlighted the importance of robust financial regulations and the need for greater oversight of financial institutions in emerging markets. The anticipated 50% market growth in the banking supply chain, real estate, and insurance industries by Q4 2025 reflects a confluence of macroeconomic factors, evolving global competitive dynamics, and regulatory changes, particularly in Asian and European markets. Each sector is poised for transformative developments as organizations adapt to the shifting landscape. 1. Banking industry outlook. The banking sector is expected to face a mixed environment in 2025, characterized by lower interest rates and slow economic growth. As central banks, including the Federal Reserve and the European Central Bank, respond to inflationary pressures with rate cuts, banks may experience reduced net interest income due to high deposit costs. However, the increased demand for mortgages could mitigate some losses. Key predictions. Adaptation strategies. Banks will need to recalibrate their business models, focusing on enhancing non-interest income through diversified services. Regulatory changes. The Basel III Endgame proposals may lower capital requirements, potentially increasing M&A activity among smaller banks. Technological integration. The adoption of AI and digital tools will be critical for efficiency and competitive advantage. 2. Real estate sector recovery. The commercial real estate (CRE) market is showing signs of optimism, with 88% of executives expecting revenue growth in 2025 after 2 years of decline. The anticipated interest rate cuts and declining inflation rates have positively influenced sentiment. However, challenges remain regarding the refinancing of maturing loans. Key predictions. Investment shifts. Increased focus on sustainable real estate and deep energy retrofits to meet regulatory demands will be prominent. Sector performance. While optimism exists, the office sector will likely continue to struggle with high vacancy rates, while logistics and residential properties may see improved demand. Technological innovation. CRE firms are expected to invest heavily in technology, leveraging AI for operational efficiencies. 3. Supply chain dynamics. The supply chain industry is poised for significant improvements, driven by the lessons learned from recent disruptions. Companies are increasingly investing in digital transformation to enhance operational resilience. Key predictions. Increased efficiency. Adoption of advanced technologies will streamline operations and reduce costs. Resilience building. Organizations will focus on diversifying supply sources to mitigate risks associated with geopolitical tensions. Sustainability initiatives. Companies will prioritize sustainable practices to address environmental concerns and regulatory pressures. 4. Insurance sector trends. The insurance industry is expected to grow as companies adapt to changing consumer demands and regulatory landscapes. Innovations such as AI and data analytics will enhance underwriting processes and risk assessments. Key predictions. Product diversification. Insurers will introduce more tailored products to meet evolving consumer needs. Regulatory compliance. Companies will need to navigate complex regulations, particularly in Europe and Asia, impacting product offerings and pricing strategies. Technology investments. Embracing digital tools will be crucial for improving customer experiences and operational efficiencies. 5. Common themes across industries. Economic uncertainty. All sectors will grapple with macroeconomic pressures, including inflation and geopolitical tensions, which could impact growth trajectories. Technological integration. Digital transformation is a recurring theme as firms strive to leverage AI and other technologies for improved efficiency and competitiveness. Regulatory adaptation. Evolving regulations will significantly influence strategic decisions, particularly in the banking and real estate sectors. 6. Timeline for growth and recovery. 2023. Economic uncertainty leads to subdued growth expectations across sectors. 2024. Anticipation of interest rate cuts and regulatory changes begins to shift sentiment positively. Q4 2025, expected growth of 50% as firms adapt to new market conditions, though challenges around refinancing and regulatory compliance persist. Conclusion: the outlook for the banking supply chain, real estate, and insurance industries is marked by significant growth potential driven by strategic adaptations to macroeconomic conditions, technological advancements, and evolving regulatory landscapes. Companies that proactively navigate these changes and invest in innovation will be well positioned to capitalize on the anticipated market growth by the end of 2025.